Good morning, everyone. Welcome to Windsor Brokers live daily market outlook. Today is Monday, 3rd of December 2012. We are the first working day of the last month of the year. The positive sentiment regarding the euro is still in play as single currency rallied again during the night on the supportive data from China. Euro hit 6 months high against dollar. As subbit data from Chinese economy boosted the already existing risk sentiment, and basically the euro breached 130.25 barrier, approaching 130.50, our next minor resistance en route towards 131 psychological level. Also the good positive data from China that basically showed that China's economy picked up in November. Pushed also the energies as crude oil hit levels approximately $89 per barrel for the January contract. Gold remains still under pressure despite regaining some levels at 1720. We mentioned in our last Friday's analysis that this is a sort of a critical point, and if it doesn't go higher, it's the fiscal cliff, the current situation in the United States that basically limits the gold's gains. Back to euro as at break above 130, and the last week's close just under a few ticks under the psychological 130 barrier keeps the positive sentiment in play for possible further extension higher as we have 131 now in the near term. Focus with investors now being back to the risk, looking for further gains of the single currency. From the other side, sterling remains quite limited. 160 seems to be quite a tough barrier, as repeated attempt higher last Friday did not result in any clear break. We have seen 160.61 and then a sharp reversal, showing that the pair is lacking momentum for a strength, for final strength through 160.50 to open 161 level, with the current price action being entrenched between 160 and the 159.90 range, with the lower range floor at 159.60. This is also seen as a break point, and basically a violation of these two supports could be quite risky in the short-term run for the sterling, as this would signal basically triple top at this point and allow for a deeper reversal. Conversely, break above 161 is seen as 160.50 is seen opening way towards 161. Dollar yen at the back foot of last Friday's peak at 82.74, again lacking strength to regain key barrier at 82.83, and the open way towards our initial target at 83.00. Currently in the corrective consolidative mode, still holding above 82, with weekly close above this level, keeping a positive tone in play, with the moving averages now holding the downside at 82.20, where the overnight dips have so far been contained. Dollar Swiss remains under pressure, posting marginally a fresh low this morning at 92.42. Main focus remains down at 92.13, our main support, and 92 as a round figure. Basically, this is also the floor of the larger pictures consolidative range, limited on the downside by 92, on the upside by 95, and the risk of continuation of a larger downtrend of dollar Swiss from 99.70 yearly peak is quite high at this point, as all indicators are still in the negative territory and pointing lower. As said, gold is still under pressure following a recovery last week to 1750, and currently at the fifth wave of reversal from 1750, with downside so far being contained but 1705, but failure to regain important 1735-38 barriers still keeps pressure at the downside, as last Friday's dips on the market just before the market closing down to 17.08 see more risk towards the downside. And finally, we look at the crude oil that is again regaining strength after entering the dangerous area below 86 level, 85.35 seen. Now up, the near-term focus is again turned towards the upside. 89.28 seen so far. This is the overnight's high. More focus towards the upside barriers of the current range. 89.20 has already been cracked, and 89.77, this is the peak of 19th of November, a break of which to open our break points at 92 and at 90 and 91.40 Fibonacci level. That will signal some stronger recovery. This was a brief outlook of the markets, and now we're going to take a look at the calendar for today. I do apologize, we are introducing a new calendar most likely during this week. It's going to be something completely different, state-of-the-art interactive calendar, not like this one. Again, we have some technical problems as the things are mixed up, but we're going to look by times and see. The most important releases seen during the night were from China, as PMIs went higher. Just ignore this percentage sign. This is not about this. 55.5 was October's manufacturing PMI. 55.6 came in November, showing that economy is picking up, though it's marginally higher increase, marginally higher high from the previous one, but still showing a expansion of the Chinese economy. And the final manufacturing PMI came at 50.5 compared to 50.4 forecast, and the previous month release, October's release. From Europe, retail sales from Switzerland have already been released. The calendar hasn't been updated, but we're going to get the figure right now, and I will tell you. Meantime, just to take a look of the coming events, Swiss PMI is due at 8:30 GMT, with the forecast at 47.8 compared to 46.1. Again, I do apologize for the mistakes in there shouldn't be percentage, should be the around the figure. Just to have a quick look at Swiss indicator came at 1 point. I do apologize. There is another mix-up. Retail sales, I do apologize. Retail sales came at 2.7 compared to 2.3 forecast, better than forecasted, but well below the September's 5.4%. As said, the manufacturing PMI is expected, PMI is expected to pick up at 47.8. That's the forecast compared to 46.1. Today's release of PMIs worldwide, I would say, as Eurozone 1 comes at 9 o'clock GMT, 46.1 changed according to expectation from the previous month. And then UK continues at 9:30. November release is forecasted at 48.1. Again, more positive from 47.5. From US, manufacturing final manufacturing PMI for November comes at 1400 GMT. No changes expected at 52.4 is the forecast compared to 52.4 in the month of October. And ISM manufacturing prices due at 1500 GMT, forecasted at 54.3, slightly below the October's release at 55. And pardon, ISM. Okay, this has been repeated for some reason. We have the major mix-up in the calendar. So just not to confuse you more with these things, we are going to move to the technical part. We expect by Wednesday that the new calendar will finally be loaded in our page, and we will try to forget all these problems that we are having now with our calendar. Anyway, we have seen that today's PMI's day, so we're going to focus on all releases related to these economic indicators. Back to the currencies. Hourly chart on euro-dollar shows fresh strength during the Asian session over last Friday's peaks at 130.26, 130.42. Pardon, 130.46 seen so far, as the pair approaches 76.4 Fibonacci retracement of the down move from 130.170 down to 126.60. Also emerges out of the daily Ichimoku cloud top that is at 129.90, break of these levels along with the psychological 130 and break of double top at 130.25, as well as Fibonacci 76.4. We don't have it here, of the lower the reversal from the lower top at 130.138 gives us now good possibility for a further stretch, and the possible test of 131 as our initial upside target. Hourly structure is positive, as indicators are in the positive territory above their midlines. The similar is the 4-hour situation. That is more indicative at this point, as all indicators are picking up now and starting to point higher following the brief corrective action after hitting a high at 130.46 with the 130.20 containing dips. This is ascending 10 days exponential moving average that contained the dips, and then we have the next dynamic 130.16, pardon, the 20 days exponential moving average ahead of 130.00 is around the figure support series of supports seen below, pardon, 131, 129.81, 129.67, 129.43. Basically, any dips should be contained above 130 to keep the immediate bull run in play, while again the significant 120.82 is the 38.2% retracement and the last overnight's low. Any violation of this level could delay immediate bulls for a possible stronger corrective action, but as said, overall positive tone keeps the focus on the upside, as daily indicators are all above their midlines and all pointing higher. That gives us good outlook for possible test of 131 en route. There we have 130.82, the tentative bear trend line connecting 131.70 and the 131.38, and basically regain of 131.00 to reintroduce our double top at 131.70, high of 17th of September, and the 131.38 peak of 17th of October 2012. As said, only violation of 129, we set 129.80, 129.82, 129.60 could delay bulls, could be signal for some stronger correction, but only break, I would say, below 129.40, 129.20, another Fibonacci supports would sideline the bulls at that point, and probably to turn shift focus towards the downside levels 129.00, 128.79. For now, bulls remain in play, and the positive sentiment established on the initial break above 130, and the shallow correction that held just below 130.00 as psychological support keeps more focus towards the upside. Of course, a lot again depends on the fundamental side, as Greek problem is still under the in the near term focus for the currencies, and the most likely solution for this will be found recently, as a general agreement has been reached between the Greece and their creditors. Of course, the American stays as #1 problem and fiscal cliff, hoping that, as President Obama said last week, that agreement between the Democrats and Republicans will be found by Christmas. That will, of course, avoid a more disastrous scenario of further tax increase and most likely country entering a recession. Of course, the biggest world economy, if the biggest world economy enters recession, then of course the chain reaction will be dragging the other economies that are already in troubles, and of course the outlook would change significantly towards the negative side. From sterling, as we said in the introduction, the 160.50 is still quite tough resistance, as we can see on the ADX hourly and the 4-hour bulls lost the steam, and they ran out of steam, and they basically stayed capped. Still some positive tone seen on the daily, but of course requires a break above 160.50, 160.61, the recent congestion tops. The near-term structure is still holding a positive tone, as shown on the 4-hour chart, as indicators are above their midlines, and the fresh momentum seen emerging now for a possible renewed attempt towards this level. This is also the upper 20 days Bollinger Band, a break of which is required to open upside barrier at 160.92, initially 76.4% Fibonacci retracement of down leg from 161.74 to 158.26, and of course 161.00 as a round figure resistance. Hourly structure is picking up the pace, still needs some extension higher to confirm, as MACD is now just emerging above the midline, being basically in the neutral mode during the recent movements, showing no action, with the downside being so far good, well supported at 160.00 as a round figure support, and then range bottoms at 159.87 and more significant 159.60. Basically only break below 159.60 could delay immediate bulls. Of course, before this set 160.20, 160 is the initial support, reinforced by 55 days ascending exponential moving average, while only break below 159.60 could be signal of delaying immediate bulls and allow for a deeper reversal, deeper corrective action. Basically, it will signal that the pair is unable to clear important 160 50-60 barrier. 159.60 is also between close to 38, basically between 38 and 50% retracement, and seen as a break point in case of failure to break the upper boundary of the current congestion. Then we might see the deeper reversal, and the break below these levels could be a signal of a triple top bearish signal for possible further extension lower, with the 159 zone expected to come in focus. We have Fibonacci supports 59.43, 59.16, 50 and 61.8% respectively, and then once 59 seen next in case of failure. Conversely, break above 160.55, as we said, will open 161.00 as our next upside target. And the dollar yen holds the positive tone, but unable to break and to fully retrace the recent corrective action of 82.83 that found the bottom at 81.68, and subsequent fresh strength stalled at on approach at 82.74, triggering another corrective action down so far to 82.25. We need to see the dips holding above 82.00, which is approximately 61.8% retracement of the rally from 81.68 to 82.74 to keep the immediate bullish structure in play. However, quite discouraging is hourly structure that shows the negative tone now prevailing, as indicators broke below their midlines, and the price holds below all three moving averages. Recent break below 55 days one that is now moving sideways, and the 10 and 20 days one already pointing lower, could see another additional pressure at the pair in the near term. 4-hour structure is still holding positive tone, but most of indicators are now pointing lower, and see immediate risk of a possible break below 82.00. That is also the 55 days exponential moving average of the 4-hour chart, and the main risk is seen on the violation of 82.00. That would introduce the recent range floor at 81.68, the loss of which to open way for a deeper reversal. We have 81.39, pardon, 38.2% Fibonacci retracement of 79.06 to 82.83, loss of which, and another important 81.00 to put near-term bulls on hold in favor of a stronger corrective action. Conversely, a set regain of 82.83 opens way towards 83.00, our next upside target, and then we have 83.30 peak of 1st of April 2012. And finally, dollar Swiss that remains under pressure and continues to tick lower. Series of marginally lower tops and lower lows keep the near-term bears of 93.39 fully in play for possible test of our key support at 92.13. As shown on ADX studies, the bears are still in play and keeping a focus on the downside, as immediate upside action of overnight's low at 92.42 has been capped by descending 20 days exponential moving average, and the focus remains, as I said, at 92.13 low of 17th of October 2012. Basically, this is also the consolidative range bottom. We have the consolidation from mid-September on the downside 92 zone, at the upside 95 zone. Failure to break this level that also marks 38.2% retracement of the larger down move from 99.70 to 92.13 resulted in the fresh leg lower, and now the immediate support and the key support, actually key level at 92.13, comes under increased pressure. Unless we see a gain of 93 approximately, this is the break. This is seen as a break point for the near-term price action. 93.00 is approximately here. These are the previous peaks: 92.90 last Fridays and the last Thursdays at 92.97. Break of 93 would provide a term relief. This is also marking approximately 61.8% retracement of the latest 93.39 to 92.42 down leg, and the only regain of 93 would provide us near-term relief and avert immediate downside risk. Otherwise, risk asset, near-term risk remains at 92.13, 92.00, break of which is to signal fresh leg lower, fresh phase lower of the downtrend from 99.70 that was interrupted during the past 2 months or so by the consolidative action that was limited at 95.00. From Ichimoku studies, bears remain fully in play. Bears supported as the pair broke below the base at 93.00. So now this is acting again as a resistance along with the Fibonacci resistance. We have the Ichimoku daily cloud base as in a resistance at 93 zone. So far, the negative tone that is prevailing with the price holding below the cloud and the Tenkan-sen line breaking below the Kijun-sen line, keeping the focus at the downside 92.13, 92.00, seen as the next downside target, violation of which to open a fresh phase lower towards 91.50 and 91.00. And finally, the commodities, as said, crude oil gained some pace, positive tone, and the bulls are firmly in play now, as shown on the ADX on the 4 and 1 hour. 1 hour bulls already are now running out of pace, but fresh strength that dented our initial barrier at 89.20. This is the previous peak of 6th of November. Keep focus on the upside towards 89.77, 19th of November high, with brief attempt through 55 days, daily 55 days moving average, keeping the upside in the focus. Daily studies are showing a fresh momentum, yet MACD is attempting to break above the midline. Break of 99.77 and 90.00 is to confirm this bullish stance, as this was originally signaled by diamond bottom pattern. If you remember, in the previous sessions we have mentioned it, not to draw the lines again, with the price escaping of the dangerous zone at above 85 on the last week's dip from 88.50 down to 85.35. Fresh strength is now again shifting near-term focus towards the upside. Near-term structure 4-hour indicators remain positive, and see potential for some corrective action. That is, I think, more yes, it's signaled on the overbought conditions on the hourly chart. As we can see, the RSI is already pointing lower, MACD is pointing lower, all the indicators basically are pointing lower. Immediate dynamic support is 88.76. It's the 20 days exponential moving average, along with the previous peak at 88.67 and 88.50. And then we have more And then we have, 88.16, the 255 days exponential moving average. More significant would be 88.00 is around figure, and 38.2% at 87.78. I would say at this point any stronger dips should be contained above this level, above 88, in order to keep the immediate bullish structure in play for a possible fresh attack at 89.77 and 90.00. Basically, on the upside, our targets are 90.00 and the 90.42, 38.2% retracement of the larger 100.72 to 84.05. That will confirm the bottom at 84 zone and the open way for a stronger recovery of the down move from 100.72. Again, crude oil remains also driven not by technicals but also by fundamentals and political news. Recent unrests in the Middle East, especially the recent clashes between Palestinians and Israelis, gave some boost with the, of course, positive Chinese data. The one of the top consumers of the crude oil that were released during the night gave additional boost to the oil price. We'll be watching our upside barriers that are in the near-term focus at 89.77 and 90.00, break of which will be very positive for the near-term price action, while on the downside we have 88.50, 88.00 needed to contain near-term dips in order to hold the recent positive structure of 85.35. Finally, we have yellow metal running out of steam in the fresh leg of 17.31 last Friday's high, shifting basically the focus again towards the downside as failure to reach our initial upside targets. Fibonacci expansion levels at 1761 and 1771 basically resulted in congestion at 1750 and then sharp fall lower with the brief recovery being capped by descending 55 and 20 days moving averages, with the bearish crossover of these two lines putting additional pressure as last Friday's fresh slide dipped again down to 1705 support, 1708 seen so far. A more negative tone, as I would say, at this point is seen for the yellow metal, as most indicators are holding in the negative territory, and the bearish momentum is building up now. Unless we see a gain of 1731 last Friday's peak, most likely scenario would be a fresh lower top and a fresh extension down towards our key support zone at 1705 and 1700. That may allow for some deeper corrective action. So far, ascending 90 days moving average on the daily chart at 1706 currently contains the downside, while break below these levels could be quite risky for the near-term price action, as this might introduce a further retracement of the from 1672 to 1752, a peak of 23rd of November, with the also strong Fibonacci support 61.8%, reinforcing the 1700, 1705 support. As said, quite a negative outlook seen at the beginning of the week for gold. Unless we see a gain of 1731, 1735, then more focus will be on the downside. Of course, a break below the recent base at 1700 is to open way for a fresh weakness and confirm the near-term top at 1752, posted on posted last week, basically. That was all from my side. Please, if you have any questions, say if you want any other instrument. I have complained that I'm unable to hear the voice. It seems that you should check your equipment because I am showing no mistake. We had some technical problems last week, but it seems that everything is running fine now. Is there any question you would like to take a look on any other instrument or anything, because I see some new names this morning, and the usual procedure goes as follows. I do the presentation, and at the end you can ask your questions. You can type and submit your questions, and then I answer them one by one. Regarding this technical problem, I suggest you check your equipment, because no one else complained except you. So it could be that it's a problem with your speakers or whatever. Okay, we have no questions. Just wanted to introduce to the newcomers the procedure. So in case of any question, any other instrument that you would like to me to analyze and give you some more detailed outlook, you can do it at the end of the session. Since we don't have questions, I would like to thank you all for being with us, and hope to see you again. Our sessions are on a daily basis. We are back tomorrow morning, Tuesday, at the same time at 8 o'clock GMT, 10 o'clock local Cyprus time. I don't know which time zones you are, but referent one is GMT. Again, thanks again to everyone, and wish you a nice day, and of course very good and profitable and successful trading. Good luck.